Hi guys, we're going to talk about risk profiling. Risk profiling is simply how much risk you want to take in your investments, whether that be super or non-super. And one of the ways we do that is we get you to fill out our risk profiling questionnaire. And I'm going to run you through this really quickly to address some common questions that we get. But firstly, before I go into that, I just want to actually outline some of the common questions that we get with regards to risk profiling. And one of the most common questions that we get is in and around what is actually a balanced profile. Because a lot of the times you see in the media that balanced profile funds might be performing very well against other balanced profiles. And the one thing that I want to tell you here is it's not about the name, it's about the percentage of growth assets, right? So what do I mean by that? Is in the terms of superannuation, there's no prescription on how much growth assets, so growth assets being shares, property and infrastructure. Infrastructure is debatable as to whether that's a growth asset, but we put it in a growth asset class. Right, so they're investments that can go up and down substantially over time. Defensive assets are things like term deposits, cash, government bonds, corporate bonds, things of that nature. Right, so within a risk profiling context, we consider a balanced fund personally to be where you have 50% assets in defensive asset classes and 50% in growth asset classes. All right, so don't get confused when you see a balanced fund saying that they've got outstanding performance as opposed to potentially yours. Don't look at the name of the fund, ask the question, how much of your assets are sitting in growth and how much are sitting in defensive? So that's really the key. Right? So how much have you got invested in investments that can go up and down aggressively, and how much have you got in defensive asset classes? So the next step is really to run through your risk profile. So there's just a few questions to run through here, and I'm just going to very briefly give you some context in and around it. There's no right or wrong answer, it's how you feel. So the first question is, I have a good understanding of investments and financial markets. You can either strongly agree, strongly disagree, or sit on the fence in the middle somewhere. So that's just whether you fundamentally understand the financial world very well. The second one is, I feel that my financial position is strong enough to accept a degree of risk. Now, by a degree of risk, what we mean is putting more money into growth assets like shares, property and infrastructure, so on and so forth. Right? So it's a degree of risk. So if you strongly agree, you believe, yes, your financial position is strong enough that you can substantiate periods of time of negative performance. Perhaps if you're later on in life and closer to retirement, you might feel that taking on more risk is not something that you want to do. I am willing to accept risk to achieve a higher investment return. Pretty much self-explanatory. If you want higher returns, you will take on higher risk. Simply that means that there's a greater chance that your investments can go down over time. I feel I have a lot of control over my financial future. That's just a feeling. So if you feel like you do, strongly agree. If you feel like you don't, strongly disagree. Which of the following best describes my investment preference? Now this is one which we get the most questions in and around. So the first one is we want to maintain the current value and capital above all other considerations. So this is a conservative stance. This is saying that you do not want any volatility, which is price movement up or down, in the investment funds. So things like cash and term deposits would be your bias here. If we look to the other end of the cycle, we'll look at, I want a focus on long-term growth above all other considerations. Now what this means is that you're looking for growth. That's all you care about. So you'll be heavily invested in shares, property and things that can substantially go up in value. Or you might sit somewhere on the spectrum in between. So just decide what's right for you. This is another one that we get a few questions on. It's how long before you anticipate needing access to a significant part of your funds. Right, so if this is superannuation, for many of you it may be more than 7 years because you're more than 7 years from accessing your superannuation. If you're in pension mode, consider more than half. So if you've got $1 million sitting in superannuation, how long until you feel like you're going to need to access $500,000 of that? Right? And if it's investments that are sitting outside of superannuation, the same thing applies. We run a different risk profile for internal investments in superannuation to external. Given that you're seeking a long-term investment plan to meet your goals and objectives, how often would you be prepared to accept a negative return, so a fall in value of your investments in any 12-month period? So let's put it this way. If you've got all of your money invested in term deposits or bonds, it is likely that they're going to suffer very few, if not no, negative annual years. But if we look at today, and this is 2019, interest rates are very, very low, so you're not going to get a lot of growth, right? So if you're willing to accept, say, once every 4 years, that might be that you've got most of your money invested in shares, where it can go up 20 or 30% in a year, or 10%, but it might also dive in a single year of, say, 10, 15%, or given what just happened prior to Christmas, international markets are almost down 20%, which means that over that 12-month cycle, you have suffered one negative year in the last 4. So how often are you prepared to accept a negative return? The longer the time frame, the more conservative you are. The shorter the time frame, the more risk you're willing to take. And how would you react if your investments were to fall by 20% or 25% or more in a single year? Right, again, this is judging your appetite for risk. If they fell by 25% in a single year and you wanted to withdraw all of your money, then that means you don't necessarily have the kind of risk tolerance it takes to put all of your money into equities. That's fine, just means we develop a slightly more conservative portfolio for you, right? If you're willing to buy more of that investment when investment markets fall, well, that means that you're substantially more aggressive in your approach. So investment markets fall, you actually put more money in, which would compound the positive performance when markets turn, if they turn in that investment. And then finally, how much of your investment portfolio would you like as a percentage to put into growth assets? Growth assets are things like shares, property, infrastructure, so on and so forth. So these are the more risky investments. So it might be you don't want any exposure to risky investments, or growth assets as we call them. It might be that you want all of it in there and you want no defensive whatsoever. It's just your preference. So fill that out, and then you can have a look at what topic you fall into, and we've named them from preservation, conservative, moderately conservative, balanced, assertive, and aggressive. But remember, it's not about the name, it's about the mixture of growth versus defensive assets.